Hey YouTube, welcome to the Subprime to Prime YouTube channel here. Our focus is to get you from subprime to prime, and then all starts with knowing where you want to go on our financial journey. And this is for information and educational purposes only, not intended to be financial or legal advice. Hit that subscribe button and that like button and follow us for more information on all things financial literacy. Alright, let's dig into it. So in this video we're going to talk about the fractional reserve banking. Okay, and it's basically like a fundamental concept in the banking system, which allows banks to lend more money than they actually hold in cash. Now, for some folks, we've known this for some time now, most of our adult life, and others have not yet really truly understood how it is that banks operate. Okay, now this system plays a crucial role in the economy by facilitating, the expansion of credit, thus increasing liquidity and encouraging economic growth. Okay, here's the breakdown on how it works and its implications. And then, of course, there are some benefits and always risk. Okay, so how it works: deposits, banks thrive and are able to make decisions based on the deposits. When you deposit money in a bank, the bank doesn't just hold all of your money in a vault or anything like that, like you would see in like the old Wild Wild West days, or anything like that. Instead, it keeps a fraction of the deposits on hand as reserves, and this fraction is determined by the central bank regulations known as the reserve requirements. So in lending, the bank lends out the remainder of your deposits to other customers. This is where the term fractional reserve comes from. Now, the bank only keeps a fraction of the deposits, and as reserves, and uses the rest to give out in various loan types. So through lending, banks are effectively creating new money, like out of thin air. When a bank gives out a loan, it doesn't physically hand over cash. It credits the borrower's account with a deposit of the loan amount, thereby increasing the total amount of money in the system. Now here goes one of the implications here, or actually a few of them. Now, credit expansion. This system allows the expansion of credit as banks can lend more money than they physically hold. It supports economic growth by providing businesses and individuals with access to funds for investments and consumption. And the banks earn money on the difference between the interest rates and pay on deposits, and those they charge on loans. This spread is crucial for their profitability. That's how they make their money, on the interest rates that they charge you. And keep in mind, interest rates are dictated by the Fed, so they pass on that prime interest to you, and then your credit figures in the amount that they get on the back end based on how likely you are to pay them back. So, multiplier effect. So in the process of lending and redepositing, it creates a multiplier effect, and it significantly increases the money supply in the economy beyond initial deposits. So the benefits of that is it helps the economy grow, so making more funds available for borrowing. And then fractional reserve banking supports investments and consumption. And we are the biggest consumers on earth. Americans are the biggest consumers in the world, right? So that drives economic growth, and it provides liquidity to the economy, ensuring that people and businesses have access to funds when they need them. Now, the risks, however, like if too many people were to withdraw their money at the same time, the bank might not have enough reserves to cover these withdrawals, leading to what we call a bank run. And of course, excessive lending can lead to too much money in the economy, which can drive inflation if it outpaces economic growth, which is what we are experiencing currently. And the interconnectedness of banks means that the failure of one institution can have a domino effect. So remember this past summer when we had the whole Silicon Valley Bank, when it failed, it was going to be quite a few of those banks that were going to follow suit. And what happened during that time was people who had their money in that bank, all banks are supposed to be insured by FDIC. So the federal government had to bail them out up to the $250,000 that it's insured by. So if folks had $5 million in the bank and they were going to get back only, $250K, I mean, I don't know how you would feel about that, but whew, that's a tough one to swallow. So that's why we have regulation and oversight. So to mitigate these risks, central banks and regulatory agencies, they impose reserve requirements, how much you must have in case stuff happens, So they can conduct oversight and offer protection mechanisms so that, like the FDIC, the Federal, Deposit Insurance, that guarantees that the government the Fed will pay up to $250,000 on the deposits in the bank. And these measures are supposed to maintain stability in the banking system and protect depositors, but as we know, some of this stuff doesn't work how it's intended to. Now, fractional reserve banking is the cornerstone of how modern financial system is made. So, but it enables banks to lend and create money, which supports economic activity. However, it also introduces all of that risk that we just spoke about. So, if you never knew that was how banks operate, these things are not taught in school, and it's, in our financial world, these things, you have to kind of understand them so that you can make more informed decisions about how you bank, where you bank, and things like that. And over on the Subprime to Prime school platform, our school group in the school platform, we talk about this stuff in depth and more. So hop on over to the school platform in our Subprime to Prime group, and we'll see you next time. All right.